Hello, my name is Benjamin Hart. I'm an American attorney and the Managing Director of Integrity Legal here in Bangkok, Thailand. In this video today, as the title suggests, we're going to be discussing global intangible low-taxed income, as well as so-called foreign-derived intangible income. Basically, what are we talking about with respect to this? Well, first of all, let's put this in perspective. In other videos on this channel, I've discussed so-called Trump tax, as I call it. I believe it's H.R. 1 from the government printing office. I think the name of the act, the title of the act is the Tax Cuts and Jobs Act, for lack of a better term. I think that's what it was called. But H.R. 1, basically, as I call it, Trump tax. It's the newly promulgated tax regime that's come about from the new administration in the United States. So, global intangible low-taxed income. As I sort of pontificated on in a prior video on this channel, it's my opinion that the tax powers that be, if you will, are trying to create a system that disincentivizes opacity abroad and incentivizes disclosure of matters pertaining to American operations of American-owned or American-operated companies abroad. And this is being done in various ways. As noted in the prior video on deemed repatriation that's on this channel, there's ways that this is being done with respect to so-called retained earnings. There's also, as noted in the video I've gone through, I think with respect to large corporations, I actually think that their international operations are going to get a lot more straightforward, especially where a large multinational is operating, or at least has an onshore incorporated entity in the United States. I think this could, the Trump tax plan could result in a much more streamlined and, at least relative to the prior regime, a lot of tax mitigation factors. For the individual who just happens to own a company overseas, or more than one company overseas for that matter, or the individual who's maybe in fact just operating or is in a minority position with respect to a company overseas, depending on their position. I actually think that this tax initiative could in a lot of ways create some, I won't say problems, but it could create some difficulties because disclosure is going to be important as part of this. And also, again, there seems to kind of be, for lack of a better term, a war on opacity, sort of the murky nature of, it just comes with the territory in certain offshore jurisdictions that, they're just not as sophisticated, for lack of a better term, with respect to tax enforcement, and regulatory enforcement compared to, say, the United States. That being said, not all jurisdictions are like that, but there simply are jurisdictions where they take a different view on things like ready cash of a corporation, or they take a different view with respect to how detailed bookkeeping, ledger keeping, and accounting needs to be. Especially in jurisdictions that have very little onshore taxes, and it'll depend. Most jurisdictions I've ever dealt with that have a fairly low onshore tax rate, they still have quite strict rules with respect to disclosure and accounting. But that being said, there's just differentiations between jurisdictions in how they deal with issues pertaining to things like, for example, retained earnings. And as a result, it looks to me like, especially with this global intangibles, you've basically got a regime where they're trying to get a handle on basically taxing what can only be described as intangible income that can't be sort of readily defined, for lack of a better term. Under the new law, Section 951A, global intangible low-taxed income now is included in gross income of United States shareholders. So that's an interesting component. As part and parcel of that, they're basically going to come in and throw a mandatory minimum tax rate on that global intangible income. this is the other thing, as I mentioned before. Again, I think that this stuff is designed to keep people from moving income around within entities so as to avoid having personal income that may create disadvantageous positions from them with respect to their individual income tax position. So what am I talking about here? Like, for example, let's just take again retained earnings. There may be a set of circumstances where within one fiscal year, or I shouldn't say fiscal, within one calendar year, it's not advantageous to go ahead and just pay oneself out a bonus out of a company's retained earnings, in say December. But if one turns around and pays it in January, it'd be a better deal because, you can essentially shift that burden from one place to another, or fully shift it entirely where, you just keep assets in the company rather than move it into one's individual balance sheet, for lack of a better term, move it onto oneself as individualized income. There's just going to be a certain set of situations where that would be advantageous under the old regime. Now with this intangibles, it looks like they're trying to, again, disincentivize opacity, and they're trying to disincentivize the shifting I'm talking about, where one sort of keeps what can only be described as controlled assets or controlled funds in a corporate structure so as to sort of sidestep possible tax liability. It seems that they're trying to disincentivize that kind of behavior. And then U.S. shareholders, I should say, of controlled foreign corporations are going to be subject to U.S. tax on this global intangible low taxed income. Again, this is just a term that they've come up with, and this is the trick of law, which is, you sort of invent your own language and then create the enforcement scheme by which you're going to go ahead and deal with that. So, having stuff deemed global intangible low taxed income and owning shares in a company that has that type of income in it can be problematic in the future. It should be noted that this became effective, I should say, December 31st, 2017. So this is mostly moving forward. In my opinion, there are ways to deal with this, most notably, especially in those situations where it's rather a marginal issue. If you've got, a situation where you're sort of worried about the intangibles hitting you, probably a good idea to simply, just pay yourself, for lack of a better term. If it's a business, it's basically just, for lack of a better term, a cutout for you, like an LLC type of structure that's basically just, an entity that's designed sort of custom fit to an individual. Moving forward, it may be beneficial. I can see scenarios where it may be beneficial to simply pay a little bit extra, possibly extra income tax, rather than creating a situation where one might run into having to deal with this global intangible tax. So that being said, I'm not going to get into any further details on this specifically. There are certain deductions which are going to be associated, which onshore entities in the United States may be able to, I think it's even up to about 50%. Onshore entities can deduct off some of this stuff. But that being said, again, this should not be viewed as a definitive sort of video on this topic. It should simply be viewed as an overview, and I'm trying to provide my own insights, having recently read this and researched this topic. But this is pretty significant, and I think it will be significant moving forward for companies that have American shareholders.